Greetings, it's me, Dr. Paul Gerhardt, and this is video number 6 of our Mergers and Acquisitions series. In this lecture, we'll examine corporate restructuring with particular attention to corporate contraction and divestiture. The goal is not to memorize transaction labels. The goal is to understand why company changes its structure, how many managers choose among restructuring options, and what must happen for a separation to create lasting value. This lecture supports 3 learning outcomes. By the end of this module, you should be able to summarize major forms of corporate restructuring, review examples of successful and unsuccessful divestitures, and explain the complexities involved in implementing a large-scale divestiture. As you listen, keep one central question in mind. Why should this corporation continue to own this business? A business can be profitable and still be worth more under another owner as an independent company. So let's talk about what corporate restructuring means. Corporate restructuring is a deliberate change to a company's financial, operational, organizational, legal, or ownership structure. It may be proactive, such as separating a fast-growing business so it can pursue its own strategy. It may also be reactive, such as selling assets to reduce debt during financial distress. Managers should begin with a strategic problem, not with a preferred transaction. Leaders first need to identify what is no longer working. Only then should they decide whether the best response is expansive, contraction, financial restructuring, or organizational redesign. Expansion includes actions such as acquisitions, mergers, joint ventures, and alliances. Contractions include sell-offs, spin-offs, closures, and other forms of divestiture. Financial restructuring changes debt, equity, or claims on future cash flow. Organizational restructuring changes reporting relationships, staffing, shared services, or decision authority. These categories often overlap. For example, selling a division may require debt reduction, a new organizational structure, technology separation, employee transfers, and changes to shared services at the same time. The managerial logic behind restructuring. A corporation usually restructures because its current configuration no longer supports strategy, value creation, financing needs, or acceptable risk. Common reasons include refocusing on core businesses, raising cash, reducing debt, existing weak markets, responding to regulators, simplifying operations, or separating businesses with different growth and risk profiles. One useful idea is parenting advantage. This asks whether the company creates more value by owning a business than other owners or an independent company could create. A parent may add value through capital, brand strength, technology, customer access, procurement, management expertise, or risk sharing. The parent may also destroy value through bureaucracy, more capital allocation, conflicting incentives, or neglect. Another idea is the conglomerate discount. This occurs when investors value a diversified corporation below the estimated combined value of its separate business. Complexity, weak disclosure, cross-subsidies, and different growth profiles may contribute to the discount. However, managers should not assume that breaking up the company automatically removes it. Separation creates new taxes, costs, risks, and duplicated functions. The proper comparison is the realistic value of keeping the business versus the risk-adjusted value of selling or separating it after all costs are included. Now let's talk about the major forms of corporate contraction. A sell-off is the sale of a subsidiary, division, product line, or group of assets to another owner. The seller may receive cash, securities, debt assumption, or a combination. A sell-off can provide immediate liquidity and may allow the strategic buyer to pay more because it expects synergies. However, the seller may face taxes, transaction costs, retained liabilities, indemnities, and loss of future growth. Managers must focus on net proceeds rather than the headline purchase price. Suppose a buyer offers $900 million for a unit that is worth $700 million if retained. If taxes, fees, retained liabilities, and stranded costs total $170 million, the net value is $730 million. The apparent $200 million premium becomes only $30 million. A spin-off distributes shares of a subsidiary to parent company's existing shareholders. Afterward, shareholders own stock in two independent companies. The parent normally receives no sale proceeds. The potential benefit is sharper strategic focus, separate leadership, tailored incentives, clearer valuation, and independent access to capital. The potential cost is duplicated overhead, weaker purchasing scale, technological separation, debt allocation, disputes, and loss of shared capabilities. A split-off allows shareholders to exchange parent company shares for shares in the separated business. A split-up divides the original parent into multiple independent companies and may cause the original parent to cease to exist. An equity carve-out occurs when the parent sells a minority interest in the subsidiary to public investors while usually retaining control. This can raise capital and establish market value for the subsidiary, but it also creates two shareholder groups whose interests may conflict. A closure or liquidation may be the best choice when no buyer will pay enough and continuing operations would destroy more value. Closure is not necessarily a failure. Delaying recognition of an unsustainable business can be more damaging than an ordinary shutdown. So, here's how managers decide whether to divest. A sound divestiture decision compares at least three alternatives: retaining the business, sell it, or separate it. In some cases, closure may also be evaluated. Each alternative should be adjusted for timing, probability, taxes, costs, lost synergies, and execution risks. Managers should ask several questions. Does the business support the company's purpose and competitive advantage? Can the parent provide distinctive value? Would the business receive more capital or attention elsewhere? Does ownership create unacceptable risk or complexity? And is the market favorable? Is management prepared to execute the separation? The strongest reason to divest is not that a business is small, unpopular, or temporarily weak. It's that the continued ownership is no longer the highest value use of corporate resources. Timing also matters. Selling during weak performance may reduce the price, but waiting for a turnaround may consume additional capital and leadership attention. Managers should ask whether the current parent is truly the best owner to lead that turnaround. Okay, so then why does divestiture harder than it looks? A divestiture is not simply an acquisition in reverse. In an acquisition, the buyer combines organization. In a divestiture, the seller must separate a business that may share employees, systems, contracts, facilities, brands, data, intellectual property, debt, and services with the parent. The first major task is defining the transaction perimeter. The perimeter identifies exactly what is included and excluded. This may involve legal entities, products, brands, patents, customer contracts, supplier agreements, employees, benefits, facilities, inventory, cash, debt, receivables, software, data, litigation, warranties, and environmental liabilities. Ambiguity in the perimeter creates delays, pricing disputes, operational disruption, and possible litigation. Managers need to know not only what is being sold, but what must stay with the parent and what must be recreated for the separated businesses. Large divestitures also need dedicated governance. A separation management office is a cross-functional team that coordinates the work, tracks dependencies, resolves decisions, and holds leaders accountable. Treating a divestiture as a side project is a common reason for failure. Okay, so now let's talk a little bit about the large-scale divestiture process. The first phase is strategy and governance. The board and senior leaders define purpose, approve the direction, assign executive sponsor, establish confidentiality controls, and create decisions and escalation processes. The second phase is defining the perimeter. Leaders identify the assets, liabilities, people, systems, contracts, and rights that must transfer, because businesses rarely align neatly with legal entities. This step requires careful mapping. The third phase is preparing the business to stand alone. Managers may need separate financial statements, bank accounts, leadership roles, licenses, data rooms, cost models, technology plans, and ownership records for intellectual property and date. The fourth phase is the buyer or market process. A sale may involve an auction, targeted negotiation, or direct discussion with one buyer. A spin-off requires securities disclosure, investor communication, board formation, and capital market preparation. The highest bid is not always the best bid. Financing, certainty, regulatory approval, employee treatment, transition to PANs, and liability terms matter. The fifth phase is negotiation. The agreement allocates price, working capital, liabilities, employee obligations, intellectual property rights, transition support, representations, warranties, and closing conditions. The agreement is not merely a legal record. It's an operating blueprint for how risk will be shared. The sixth phase is separating and closing. This includes regulatory approvals, employee transfers, data migration, system access, facilities, inventory, funds flow, and communicating with customers and suppliers. The legal closing does not guarantee operational readiness. A transaction can close while the new business is still unable to invoice customers, pay employees, or access critical data. The seventh phase is post-closing stabilization. The seller must remove remaining costs, complete system migration, resolve claims, exit temporary services, retain customers and employees, and measure whether the original value case was achieved. Now, here are the most important execution complexities. Stranded costs are costs that remain with the seller after the business and its revenue leaves. Examples include excess headquarters staff, facilitating software licenses, insurance, and procurement contracts. Allocated cost is not automatically affordable. Managers must determine what disappears and what transfers, and what must be redesigned. A transition services agreement is a contract under which the seller temporarily provides services to the buyer or separated company. These services may include payroll, information technology, accounting, procurement, or customer support. A transition services agreement should be a bridge to independence, not a permanent operating model. It needs a clear scope, service standards, pricing, security requirements, governance, and exit dates. Technology and data are often the critical path. Managers must separate applications, licenses, customer records, employee records, cloud systems, source code, cybersecurity permissions, and historical archives. Access must continue for the new business, while unauthorized access is removed from people who no longer need it. People are equally important. Leaders must decide who transfers, who stays, which roles are duplicated, what knowledge must be preserved, and how benefits or incentive plans will be handled. Uncertainty can cause high-performing employees to leave before the transaction is complete. Contracts can also delay a separation. Some agreements prohibit assignment, allow termination after a change in control, or require customer or supplier consent. A business is less valuable when its revenue cannot legally transfer to the new owner. Financial reporting is another challenge. Carve-out financial statements are financial statements prepared for a business that previously operated inside a larger parent and may not have kept complete separate records. They must show a critical standalone picture while complaining how shared historical costs were allocated. Debt and tax decisions can shift between the parent and separated company. A transaction may be tax efficient, but still strategically poor. Tax planning should support the strategy rather than preserve an ownership structure that no longer makes sense. Now let's talk about how restructuring creates or destroys value. Restructuring can create value through better focus, clear accountability, improved incentives, more transparent valuation, tailored capital structures, removal of subsidies, or transfer to a high-value owner. It can destroy value through taxes, transaction costs, duplicate overhead, stranded costs, lost synergies, excessive debt, customer disruption, employee turnover, poor timing, and management distraction. Investors may react positively when a restructuring is announced, but positive stock price response only shows expectations. It does not prove the plan was implemented successfully. Managers should also examine long-term operating performance, customer retention, employee capability, margin improvement, debt reduction, and total shareholder return. Managers should also consider who gains and who bears the costs. Shareholders may benefit while employees lose jobs, communities lose investments, or customers face disruption. Ethical management requires transparent analysis, responsible communication, and practical mitigation of unforeseeable harm. Here are some lessons from successful and failed cases. A separation of eBay and PayPal illustrates strategic separation. PayPal gained freedom to partner with organizations that might have viewed eBay ownership as a conflict. The lesson is that a business may be constrained by the parent's ecosystem even when companies have some internal synergies. The separation of Hewlett-Packard into HP Incorporated and Hewlett-Packard Enterprises illustrates the scale of execution. The transaction required clear business boundaries, separate leadership, extensive planning, and the division of global systems, supply chains, employees, intellectual property, and shared functions. The lesson is that a strategically sensible separation can still involve years of follow-on changes. General Electric's multi-stage breakup illustrates sequencing. Decades of accumulated complexity, debt, pensions, obligations, and legal legacy liabilities could not be resolved through one simple transaction. The lesson is to manage major restructuring as a program or connected decision rather than a single event. AT&T's separation of Warner Media illustrates acquisition reversal. A divestiture can be the right current decision while also revealing the original acquisition did not produce the expected strategic and financial benefits. Quaker Oats and Snapple illustrates the importance of sunk costs. A sunk cost is money already spent that cannot be recovered. Managers should retain a weak acquisition merely to avoid admitting the original decision was wrong. The correct question is, which future alternative creates the most value from today forward? Regulatory divestitures sometimes fail because the buyer receives assets, not a viable business. A successful regulatory remedy requires enough employees, systems, rights, financing, and traditional support for the buyer to compete effectively. Here's a practical managerial decision checklist. Before recommending a divestiture, managers should be able to answer the following questions clearly. What strategic problems are we solving? Why might another owner or independent company create more value? What is the realistic value of retaining the business? What taxes, transaction costs, stranded costs, and lost synergies apply? Can the business operate independently on the first day after closing? Which people, systems, contracts, licenses, assets, liabilities, and data must transfer? How will debt and ongoing obligations be allocated? What could prevent closing or destroy value afterward? Who is accountable for removing residual costs and achieving promised benefits? If leaders cannot answer these questions, the organization is not ready to recommend or execute the transaction. Now let's review some key points. Corporate restructuring changes the financial, operational, organizational, legal, or ownership structure of a company. Corporate contraction includes sell-offs, spin-offs, split-offs, split-ups, equity carve-outs, closures, and liquidations. The central portfolio question is whether the parent creates more value by owning the business than another owner or an independent company would. Managers must compare retention value with sale or separation value after taxes, costs, liabilities, loss synergies, and execution risk. A divestiture is difficult because shared people, technology, data, contracts, systems, and costs must be separated. Stranded costs and weak transition planning can eliminate expected value. Closing is only a milestone. Value is realized through post-closing stabilization, cost removal, customer retention, employee capability, and operational independence. Successful divestitures have a clear strategic rationale a complete transaction perimeter, dedicated leadership, realistic economics, and disciplined follow-through. So remember, corporate restructuring is not simply financial engineering or a change to an organizational chart. It's a strategic decision about what a corporation should own, how the business should be financed, and which structures can create the strongest sustainable value. For managers, the most important lesson is that separation creates value only when the new ownership structure is better after all costs and risks are considered. The parent must receive fair value or strategic benefit and remove the costs that remain behind. The separated businesses must receive enough people, assets, capital, systems, rights, and leadership to succeed independently. The best decision is not automatically to sell, spin off, or retain a business. The best decision is the alternative that creates the strongest long-term value while responsibly considering shareholders, employees, customers, creditors, communities, and the organization's capabilities. This has been lecture number 6 on corporate restructuring. I hope that you have learned something that you could actually use. And more importantly, I hope that you have a great day because only you get to choose how you feel about it. I'm Dr. Paul Gerhardt.